Welcome back, everyone. Today on the Joseph Carlson Show, we have a very busy episode to get into. There is a ton of news. The biggest news story that we'll be diving into in this episode is, of course, that the 3 judges of the trade court striked down the Trump's reciprocal tariffs. Remember that board that he got out where he did that big presentation? He calculated the trade deficit between different nations and calculated a reciprocal tariff. This is all under the pretext of an emergency. This is all because of an emergency, and he needed to impose these big tariffs to deal with this emergency. Well, these 3 judges are saying that doesn't really count, and this really isn't an emergency. And they have blocked those reciprocal tariffs. Now, of course, this isn't where this story ends. In fact, this is just the beginning. Because anytime you have judges step in like this with some lower court, that initially causes some confusion and chaos, and then it's going to be appealed and delayed and put into bigger and bigger courts. We're going to see Trump push back on this hard. And we've already seen Trump advisors like Hassett saying that the Trump tariffs will prevail even with this setback. So today we're going to be looking at the likely route this will take, the appeals that will be made, the courts this will go to, and the ultimate conclusion that's going to happen. Now, of course, we have a lot of other news to get to. We have Intuit that reported their earnings a couple weeks ago. The stock has been like a rocket, going up 20%. This is a relatively large position in my portfolio. I want to revisit it and see why investors are so enthused about this company. We also have Salesforce that reported earnings. It was initially up 5% after the report because they beat on their revenue and earnings estimates. Now, today, the stock is down 5.5%. So what gives? Why can't Salesforce catch a break? We'll be looking at this report and diving into the data. And of course, we have Nvidia that also reported earnings yesterday after market close. This is the highly anticipated one. Nvidia is the one that everyone watches for. We'll be revisiting Nvidia's earnings and how I've adapted my view on this company. And then we also have some more news, specifically around Elon Musk. First of all, it seems like the bromance between Elon Musk and President Trump has come to its conclusion. Elon Musk is stepping down from the role in DOGE, he's separating from the government, and now he's openly criticizing some of Trump's policies, like the big, beautiful bill, the budget proposal. So we see that coming to a conclusion. We also see that Elon Musk reportedly tried to stop the deal between OpenAI and the Middle East. This is a big deal that was presented by Trump. Elon Musk warned that Trump would never bless the deal unless his company, XAI, was included in it. We'll be diving into the details of this. And then finally, we get to our fail of the week. This one is the reporter that asked Trump about the taco trade, the Trump always chickens out trade. Buying the tariff dip has made investors a lot of money. And this reporter is giving it away and suggesting that Trump is a chicken or weak when he lowers the tariffs. This is a terrible question to ask the president. We'll be going over why in this episode. Now, we start today off a little bit differently than our normal discussions. Normally, I dive into the portfolio, show how things are going, how things are moving up, and how companies are evolving. But today, we start with the discussion of power, specifically presidential power, and the concentration of power into the presidential office. Now, there's 2 different areas that I've noticed a huge amount of power being concentrated into the presidential office. These are 2 areas where I've believed that the president has maybe too much power, too much flexibility. One of them is with pardons. With pardons, what I've noticed over the past couple of years or with the past couple of terms is that the president uses the pardoning power broadly. In some cases, not even with familiarity with who they're pardoning. For example, President Biden pardoned thousands of people. He can't be intimately familiar with the case of thousands of pardons. He also pardoned people that were killers and commuted their sentence, reducing the severity of it. He even pardoned his own son. The pardoning power was used dramatically by Biden, and it's also been used dramatically by Trump, pardoning hundreds of people, many of them he's never met before, even pardoning people like Trevor Milton, a known huckster and scammer of the company Nikola, who lost a lot of money for investors in the process of enriching himself. And to me, it seems like this pardoning power may want to be looked at. It's a lot of power to pardon someone, and it's being used more frequently, more broadly, and it seems like a little bit more loosely. But the other issue here, the other one where there's a lot of power concentrated into the president's office, is with tariffs. And this is something that we found out about this presidency. That the president's ability to implement and enact tariffs under the pretext of an emergency gives him basically untapped, unlimited power to tariff every single country, every single industry, to make winners and losers, to tariff them all in different percentages, different amounts, different time periods for any reason that he wants. Now, this isn't only specific to countries, but it's also been used specifically for companies. The president is implementing specific tariffs on specific companies, threatening companies like Apple that if they don't manufacture in the US, they will receive their own specific tariff. This is a form of the president picking different rules that apply differently to different companies. And it makes it so that there's a lot of power concentrated in the Oval Office with one person in particular. That all of this commerce, all this communication, all of these transactions have to be approved specifically by the president, and if they aren't, he's going to tariff them. And this is the discussion happening now. Should the president alone be able to have this much power with tariffs, these taxes, to be able to impact markets and individual businesses to this extent without any limitations? And that's what these judges are weighing in on. This federal trade court ruled that President Trump didn't have the authority to impose sweeping tariffs on virtually every nation, voiding those levies that have sparked a global trade war and threatened to upend the world economy. The decision on Wednesday from the Court of International Trade blocked one of Trump administration's most audacious assertions of executive power. Under the International Emergency Economic Powers of the Act of 1997, shortly after the decision was handed down, lawyers for the Trump administration have notified the court that they will appeal. Now, the way that Trump has rationalized these tariffs so far is with the IEEPA, the International Emergency Economic Power Act, which the description says is a federal law that grants the president broad authority to regulate economic transactions following a declaration of a national emergency. So you declare an emergency, then you can basically do what you want. And that's what he's been doing. But the court's interpretation of this varies from the Trump administration. The court does not read this IEEPA to confer such unbounded authority and sets aside the challenged tariffs imposed thereunder. Lawyer talk for saying, we don't read this to mean that you can do whatever you want after declaring an emergency. And again, Trump has used the IEEPA, this emergency act, to impose nearly all of his tariffs. We have duties on Canada, Mexico, and China imposed under fentanyl smuggling. Then we have the far-reaching reciprocal tariffs levied in early April on virtually every U.S. trading partner. Most of those were justified by trade deficits. That was the emergency. Now, how is Trump able to enact these tariffs under these emergency powers? Well, part of that is because Congress gave him the power to do that. And the court addresses this in their ruling. Wednesday's ruling said it would be unconstitutional for Congress to delegate unbounded tariff power to the president. So they basically said, you can't do this. You can't give the president this much power to tariff with no limits. They say, quote, an unlimited delegation of tariff authority would constitute an improper abdication of legislative power to another branch of government. The judges are pointing to Congress and saying that they're failing to do their duty. They're the ones that are supposed to have restrictions on tariffs, and they can't legally hand all this power over to the president. Now, the Trump administration has already asked the court late Wednesday to pause the ruling while it pursues an appeal. Not doing so would endanger foreign policy and national security. But what's going to happen from here is this is going to get a lot more complicated. The market doesn't like the tariffs. It would prefer not to have the tariffs at all. But what the market doesn't like even more than tariffs is uncertainty. And that's the reason that even though you see this being blocked, the market isn't in the super green territory today. In fact, it's pretty flat today, barely in the green. Investors are looking at this with a lot of confusion, and that confusion's warranted because the path from here is a labyrinth of legal proceedings and different rulings that even lawyers would have a hard time guessing what's ultimately going to happen. Goldman Sachs, for example, says that this is a nothing burger, that this isn't really going to affect anything because Trump will weave and pivot to different ways to enact these tariffs. Piper Sandler, different analysis firm, said that yesterday's decision is a comprehensive defeat for the administration. So we have two different analysis firms giving entirely different conclusions on this. They say its legal arguments were roundly rejected. To aid with the White House in this case is to argue that the president can declare a bogus national emergency and do almost anything he wants. The CIT was having none of it. And we believe it's very likely a comfortable majority in the Supreme Court will take the same position as the three-judge panel. So we have the different viewpoints from Goldman Sachs and Piper Sandler. They believe that as this goes to the Supreme Court, they will rule the same. Now, you may look at the makeup of the judges to try to predict this. Maybe these were three liberal judges. That doesn't exactly look like the case here. One of them was appointed by Obama, one of them was appointed by Reagan, and one of these judges that decided on this was appointed by Trump back in 2016. So 2 of the 3 judges were appointed by Republican presidents, one of them being Trump himself. The legal reasoning behind this ruling was underpinning the basis of these tariffs, the pretext of the tariffs, that it was under an emergency. The courts found that the tariffs exceeded the presidential authority under the IEEPA. That's the Emergency Act. They did not address a true, unusual, and extraordinary threat. So the judges are using judgment here saying the tariffs, specifically these reciprocal tariffs, they're just not unusual enough. We've had trade deficits with these countries for decades. In fact, you can go back 30 years and we've had trade deficits with different countries. Over that time period, the US has gotten rich. The per capita GDP growth has grown tremendously. So to say it's an emergency, that we buy slightly more from Japan or South Korea than they buy from us, while this hasn't been anything unusual or extraordinary, it hasn't caused significant harm to the US over the past 30 years. In fact, we've continued to be the richest country in the world over this entire time period. Seems like pretty solid reasoning. That's going to be something that's very difficult to argue that that is in fact a true emergency. They said furthermore, on this point, that Congress cannot delegate unlimited tariff power to the executive branch, which is essentially what they've done. So the 2 different arguments here, a lot of what he's saying is an emergency is not an emergency, and he can't have this power to begin with because it goes under Congress. Those are the 2 different things that the Supreme Court will be looking over. Now, there's going to be a lot of appeals and uncertainty. The Trump administration has appealed the ruling, but a decision is unlikely within the 10-day window. The outcome creates uncertainty for businesses and trading partners. The alternative of authorities. The administration could use other laws to reimpose the tariffs. Section 122, up to 15% for 150 days. So Section 122 would allow him to impose these tariffs, but it does have a cap on it. You have Section 301. This one allows for unlimited tariffs, which would be President Trump's preference, but it requires a real investigation. So that one has a bigger burden of requirement. It would be more work for the administration to justify a Section 301 tariff. Then we have Section 232, sectoral tariffs. So he can tariff, but only by sector, and he has to have a rationale by sector. So these are all alternatives, but they're just not as good. All these alternative laws that he could now implement tariffs for have caps on the tariffs, or they require investigations, and they're overall more targeted by sector, or they're just more difficult to implement. So these aren't the preference because they have more procedurals and caps and limitations. He'd rather be able to operate under the IEEPA. And that is where it stands right now. This opens up a greater degree of uncertainty, the one thing that investors truly don't like. It's almost better to have bad news that we know about than completely unknown news, to have a lot of question marks, to not know fully how this will turn out. But right now, what investors are looking at is an overall significant roadblock in President Trump's tariff plan. It's creating more uncertainty today, but we'll have to see how these laws actually work out, if the Supreme Court rules for it or against it. So this is something we're going to be following. Now, moving on from this, we do have a number of companies that have reported earnings that have affected my portfolio, some of them in my portfolio, some of them out. The first one that I want to go over is Salesforce. Let's take a look at this one, and then we'll get to Intuit after and Nvidia. But I first want to look at Salesforce because this is one of the holdings in my portfolio that just, it can't seem to catch a break. Salesforce has had a really tough year. It's still in the red this year. And even after putting up what at first seemed like a decent report, the stock was up 5% after the report hit. We had a beat on earnings, a beat on revenue. They raised guidance. Overall, it seemed like things were going well, but it didn't meet analysts' expectations. And this is one of the situations where after they gave the report, it was almost difficult for investors to figure out what really went wrong. We were looking at the stock going down, and investors are trying to dive through figuring out, why is the stock going down? What wasn't good about this report? And it's very difficult to find out what was actually all that bad. For example, a few different analysts at banks downgraded the stock. RBC Capital Markets said despite the upbeat results, we've downgraded the shares to sector perform from an outperform, citing execution risk and innovation concerns if the company continues acquiring. So we have one analyst downgrading the stock because they acquired a company. Even though they didn't pay an extreme amount for it, it raises uncertainty and concern of execution and of integrating this new company. We also have the Citibank analyst, Tyler Radke, also giving a downgrade to the stock, saying Q1 results, while not game-changing, point to a stable demand environment while continuing strength in Agentforce new product cycle. He commented positively on the stock, but also downgraded it. Looking at his overall rating on stocks, he has a success rate of around 53%, or another way of putting that is his ratings are basically a coin flip. Right now, sentiment is negative on Salesforce, and we have to make it through this period. This happens sometimes with stocks. It seems like we're going to go through a wave of downgrades and lower sentiment, lower expectations for the company. And eventually, as expectations get lower, it sets the stock up for growth. If we look at Salesforce's performance relative to the rest of my portfolio, this is what it looks like. We have every holding across both of my portfolios here, and we have the dip finder, which shows how these companies have traded over different periods of time. Now, you'll notice that Salesforce off to the left here is by far the worst performing year to date. It's down over 20% year to date. So this one has gone down a lot. I'm down around a couple percentage now, around $3,000 on this position overall. Then we have Google that's also down year to date, and Amazon. So these three companies are my losers this year. These are also three of the companies that I think are at the most attractive valuations. And that's partially because of the fact that they've traded down this year. While I look at the rest of my portfolio and I benchmark it against the S&P 500, we have the S&P 500 right here, up around 1% year to date, give or take. And then we have all the other companies that have been outperforming the S&P 500 in my portfolio year to date. The rest of these are above 10% returns year to date, with MasterCard, Costco, Booking Holdings. Intuit's now up 21% year to date, and we have Netflix up 34% after having a staggering 2024. So when I look at this overall, I see that I have 11 positions that are in the green, outperforming the S&P 500 year to date, with 3 companies underperforming. And I like that ratio. The vast majority of my capital in the market has outperformed so far this year, and I can't expect that at every time period, all time periods, that every holding that I'll have will outperform or do as good as expected. In this case, Salesforce has been a disappointment. There's no other way to put it. This company has just continued to not catch a break. But when I continue to look at the fundamentals and I really try to find out if there's something severely wrong with Salesforce, a big reason for me to sell the company, I keep returning to the conclusion that I don't see anything so bad for this company. And I certainly don't see anything deserving of me selling it. If we look at their latest earnings call, we can get a lot of information from this using the Qualtrim transcript summary. This is a new feature I implemented, and it's incredible because it summarizes by topics every part of every individual earnings call. With this latest one that they had yesterday, we have some insight into the Informatica acquisition. The analysts are concerned that Salesforce is back into buy and spend mode, and that creates greater uncertainty. But I think that's a bit too steep of a criticism. The acquisition is described as accretive, non-dilutive, and well-priced, to be financed with cash and new debt, with no expected share dilution. So they're not diluting shareholders at all to purchase this company. And they're purchasing it for $8 billion. Salesforce generated over $6 billion last quarter. They can pay for it almost twice over in a single year. When Mark Benioff talked about this acquisition, he noted that he was trying to get the best deal possible. And in fact, this $8 billion acquisition is $2 billion below what it was rumored to be 2 months ago. So Salesforce didn't buy it at $10 billion. They waited until they got a better deal, and they bought the company. They say this acquisition aligns with Salesforce's disciplined, value-driven MA strategy. As long as they're doing acquisitions, I'd rather them be this disciplined and at this price level than they were previously. Now, the company grew 8% year over year. Subscription revenue grew by 9%. They say that there's strong growth in small and medium business segments, both achieved double-digit new bookings growth. The non-GAAP operating margin was 32.3%. Operating cash flow was $6.5 billion, and they don't have a lot of CapEx. So free cash flow was around $6.2 billion. It's a lot of free cash flow in a single quarter. Remaining performance obligations, RPOs, which is contracts for other companies to use their products, was up 13% year over year. And then the guidance was raised by $400 million to $41.3 billion at the high end. When we look at their new product development, Agentforce was front and center. They say that Agentforce, Salesforce's agentic AI platform, now has over 8,000 customers, 4,000 being paid, and exceeded 100 million in annualized order value very quickly. Now that $100 million that they're making from Agentforce, that comes 6 months after release. So already they're generating significant revenue with this new product. They expect it to ramp up. They say that the feedback initially has been very positive. The outcomes include dramatic improvements in onboarding time, cost saving, customer retention, revenue generating for customers. Mark Benioff notes that part of the reason that this agentic technology is growing faster than something like ChatGPT is simply because of the data being used. For example, he highlighted that consumer-generated AI adoption, stuff like ChatGPT or Gemini, are growing explosively due to open data sets and no privacy concerns. You don't really have that much information in ChatGPT, most people don't, that would be a significant privacy concern. Enterprise adoption is necessarily slower due to security, governance, and complex data integration needs. So part of this building out using their agentic technology is simply going to take a little bit more time than a user-end technology like Gemini or ChatGPT. But he says that that is in progress and they're at the lead of this integration. Mark Benioff also noted that even though they're growing top-line revenue and they continue to expand that, management is committed to maintaining margin and cash flow discipline. So they're not going to grow at any cost. They want to grow profitably. Now, I'm not going to go over the valuation of Salesforce. To put it simply, it's very undemanding. The company's already priced with a huge margin of safety, and it's growing at a moderate pace, highly profitable. So I see Salesforce going through this transitional period of getting hit with these analyst downgrades and the bank downgrades. Once it gets through that, it can resume its normal growth. The intrinsic value will grow of the company with its free cash flow per share growth, and eventually the stock price will be disconnected enough with the intrinsic value that it will be forced to move up. So I'm still in Salesforce. I'm not selling any after this earnings. Now, the next one I want to highlight that reported earnings recently is Intuit. Intuit's a company I don't talk about that much. It's frankly in a boring industry. Your tax returns and small business accounting, not exactly the most exciting of industries, but this company is incredibly powerful, highly dominant in the category that they operate in. They have high margin, subscription revenue, highly recurring revenue in nature, and the company continues to integrate artificial intelligence into everything they're doing. Another thing about Intuit is the stock is simply growing a lot faster than investors would expect. If I was to just have you guess at how fast Intuit's growing, like what percentage revenue, and you didn't know, you might guess something like Salesforce, 8 or 9%, at most 12%. Intuit's growing revenue above 15% per year. In fact, this is a fast-growing company. When we look at the highlights here of their performance over the past quarter, they delivered strong quarter with total revenues up 15%, operating income up 20% in GAAP, 17% non-GAAP, earnings per share up 19% GAAP, 18% non-GAAP. In the report, they raised their full year guidance for revenue, operating income, operating margin, and earnings per share across both GAAP and non-GAAP metrics. They did $754 million worth of buybacks, and they announced a 16% increase in the quarterly dividend. Every part of this company is growing at a moderate to fast pace. The consumer tax, TurboTax, Credit Karma performance is really good. We have Business Platform and QuickBooks, which also grew 19%. Intuit views their business as mission critical in performance for both tax and money needs, and businesses core to their operations and financial management, driven by high subscription recurring revenue and lower churn. They're guiding for next quarter revenue growth of 17 to 18%, continued margin expansion, and high teens earnings per share growth. And while we're seeing all this growth and expansion by Intuit, their stock-based comp, that pesky problem that a lot of these companies have, well, it's going down. It continues to go down. With Intuit's recent performance, there is nothing I have to complain about this report. I really can't find too much to criticize here. I have this one in the portfolio as an $83,000 position, currently $32,000 in the green. Now, next up, we have the highly anticipated Nvidia that reported once again. The earnings call summary of this company is pretty incredible. Some of the things they highlight are just staggering, mind-boggling statistics. Revenue for Q1 was $44 billion, up 69% year over year, exceeding expectations in a challenging environment. The big thing that I've become convinced of with Nvidia over the past year is that my caution initially for this company was, simply put, when I see a revenue line that looks like this. In fact, let's look at the revenue by the segments. When we see revenue like this, and this is every single quarter, it makes me feel a little cautious about the company. When you have this type of outlandish, incredible, exponential growth in a company's revenue, it makes me believe that investors should just be a little bit more defensive. They should look at the company with a bit more scrutiny to see if they can actually maintain this level of revenue. But over the past year, my sentiment has increased for Nvidia. I believe the company is safer than it seems. that the revenue is more intact, that it's less likely to be disrupted. Nvidia has really grown to become the go-to solution for everybody during this AI growth period. They have the moat, the monopoly. They've built out a technological ecosystem. They have products that are, in many cases, somewhat similar to like ASMLs in the level of complexity and parts in the product, the difficulty in replicating what they're doing. And on top of that, they've layered upon software that's unique to NVIDIA as well. So although they have competitors like ASML, and it's not a total monopoly, they're in the favored position with this AI growth. And over the past year, seeing the CapEx expansion of all of these big tech companies, I've become more convinced that this AI growth will continue. They say that the demand in AI inference, especially for reasoning and agentic AI, which is the stage that we're currently at, is driving exponential growth in data center usage. So I look at NVIDIA today, and even though the stock hasn't had spectacular performance over the past year, it's been pretty good. It's been up 26%. There's a number of stocks that have outperformed NVIDIA, but at least it's moving up today. And that's despite the very lofty expectations being the biggest company in the world, right there with Microsoft and Apple. By the end of this year, it's very likely that NVIDIA could surpass both of those companies in free cash flow or total net income. The rate of growth, the profitability, and the margins continue to move up. Lots of big tech companies are making their own processing units. You have other companies like AMD trying to chip away at NVIDIA's moat, but so far it seems like it's just too big of an opportunity. NVIDIA remains in a very strong position today. Now moving on, we get to some news about Elon Musk. He's made it into the news with multiple news stories recently. One of them being that it seems like the bromance with Elon Musk and Trump has met its conclusion. This is one of those news stories where it doesn't come as much of a surprise. In fact, a lot of people are anticipating this to happen because from the very beginning, when I look at Elon Musk and Trump being besties, there's a couple things that I just can't get my head wrapped around. One of them is that they're both so big of personalities. You have Elon Musk and President Trump, both big, eccentric, wealthy people that like being the center of attention, like being number one. In fact, Elon Musk is the type of person that doesn't like taking orders from anyone. He's the CEO and leader of all of his companies. In fact, he's not even really responding to the board of many of his companies. He's like the owner, the one person that decides everything. He's not accustomed to being second place, and neither is Trump. Trump's the president. He's not going to be second place to Elon Musk. So you have two people that are both accustomed to being number one, being the biggest personality, being the person in charge. And that leaves a very difficult relationship. It's just hard to have these two personalities be very close to each other for an extended period of time. You could anticipate that at one point or another, there would be some kink in the relationship, something that would separate the two, and it seems like we've had that happen now. Elon Musk posted on X that his time period as a special government employee has come to an end. So he's no longer being in charge of DOGE. And this comes one day after a clip surfaced that showed Elon Musk taking aim at Trump's legislative policy, the big beautiful bill. Musk said specifically that he's disappointed to see the massive spending bill, which frankly, it increases the budget deficit, not decreases. He added that the bill undermines the work of the DOGE team. Now, Elon Musk has had multiple reasons to step down from his position at DOGE, one of them being the impact on the Tesla brand. It negatively impacted the brand. There was a lot of protests, a lot of vandalism at Teslas and Tesla owners, and that was part of it as well. But he's also expressing frustration with the president's bill, and we have reason to believe that there is other things he was frustrated about in the administration as well. Elon Musk tried to block Sam Altman's big AI deal in the Middle East. Remember that big deal that OpenAI made with the Middle East? OpenAI led a group of American technology giants that won a deal last week to build one of the world's largest artificial intelligence data centers in Abu Dhabi. Behind the scenes, Elon Musk worked hard to try to derail the deal if it didn't include his own AI startup, according to people familiar with the matter. Now, this is where this gets a bit intense. He was on a call with the officials at the G42, an AI firm controlled by the brother of the United Arab Emirates president. Musk had warned for those assembled. Their plan had no chance of President Trump signing off on it unless his company XAI was included in the deal. So he's saying that this whole deal you're doing with OpenAI and these other companies, Trump is never going to go for this unless XAI, my company's included as well. Like he's trying to derail this deal, cast doubt in it, in the middle of this summit. Now, Musk found out about this deal just days before they left for this summit. The chief executive, Sam Altman, was going to be on the trip and that the deal was in the works. He grew angry about it, according to White House officials. He then said that he would also join the trip and appeared alongside the president in Saudi Arabia. And even after Musk's complaints and trying to derail this thing, Trump and the US officials reviewed the deal and the terms and decided to move forward anyway. The White House officials said that Musk didn't want the deal that seemed to benefit Altman. Aides discussed how to best calm Musk down, because Trump and David Sachs, the president and AI crypto advisor, wanted to announce the deal before the end of the president's trip in the Middle East. Now, it's very clear what's going on here. This is just petty behavior by Elon Musk. He believes that if he can't be included in this deal, if his company's left out, then no one should get the deal. Then OpenAI and all these other companies shouldn't have it either. So he's trying to cast doubt in the deal, torpedo the whole thing, because XAI was excluded from it. He's using the president and his close relationship with the president to try to insert his company into deals that they weren't supposed to be in from the beginning. And he also has done this type of behavior in the past many times. Elon Musk doesn't want Sam Altman to succeed. He's used every pretext and every different concern to try to ruin any deal that OpenAI is making. For example, back in January, when we had the announcement of Stargate, Musk undercuts Trump on Stargate AI investment announcement. He went out and said that they didn't have the money, that the deal wasn't going to go through, because of course, this is a deal for Sam Altman, not a deal for Elon Musk. When that's the case, the deal won't work, it can't happen, he doesn't want it to go through. Even at the beginning of this whole AI experiment, when everything started off, we had Elon Musk sign an open letter, along with a few other tech leaders, to pause the giant AI experiment, specifically systems more powerful than ChatGPT-4. Elon Musk, under the pretext of security, was trying to target OpenAI and stop their development. At the same time, he was developing XAI. Now that he has XAI up to speed, he wants no such halt on development. Overall, it looks like Elon Musk in this position and having this close relationship with Trump didn't yield the returns that he was looking for. Even with his attempts and close relationship, he couldn't prevent OpenAI from making these deals and making progress. Once it looks like this relationship was frustrated and he couldn't leverage this relationship, he's stepping down from it. So now Elon Musk is focusing purely on Tesla. Tesla investors are better for it. Now we move on to the fail of the week. In this case, it is a reporter that asked a question to the president that is the last question you should ever have asked the president. Let's go ahead and listen to this question here.
Mr. President, Wall Street analysts have coined a new term called the taco trade. They're saying Trump always chickens out on your tariff threats, and that's why markets are higher this week. What's your response to that?
Do you get the acronym there? They call it the taco trade. Trump always chickens out. Apparently there is a Financial Times article, it didn't get seen by anyone, where he coined the term taco trade. That Trump would initially institute these dramatic, huge tariffs, and then he would eventually chicken out and lower them over time. Now, this question, referring to President Trump as a chicken, obviously it's not the question for him. As we know more than anyone, President Trump wants to be viewed as tough. So if you're going to give President Trump a troll comment, if you're going to try to get one that's biting, one that he really doesn't like, it's asserting that he's a chicken. And here's his response.
Kick out?
Chicken out.
Oh, isn't that nice? Chicken out. I've never heard that. You mean because I reduced China from 145% that I set down to 100 and then down to another number? And I said you have to open up your whole country. And because I gave the European Union a 50% tax tariff, and they called up and they said, please, let's meet right now. Please, let's meet right now. And I said, okay, I'll give you till July 9. I actually asked them, I said, what's the date? Because they weren't willing to meet. And after I did what I did, they said, we'll meet anytime you want, but don't ever say what you said. That's a nasty question.
Now, he warns her at the end there to don't ever say what you said. That is a nasty question to assert that he's chickening out. And Trump has a point. After all, it's not an uncommon negotiating tactic to start really, really high and then come down later. That's also a common sales tactic. That's why so many stores have the real price of the item way up here and there's a 50% sale. It's a proven negotiating tactic and sales technique where people are more naturally willing to accept the lower number once they've been presented with this super high number. So I think he has a point. I wouldn't call all of this chickening out, but the fail here is the reporter asking this. My strategy so far has been to buy the tariff dip, and it has indeed been a very profitable strategy. Anytime there's a big dip because Trump comes out with this huge monstrous tariff number that is unsustainable and is obviously going to come down over time, it rattles the markets nonetheless. Investors sell out of the market because they see this huge number. That allows investors like you and me to buy in companies at a cheaper price. Once the tariffs eventually come down, the stocks go back up. And that's what's been happening over the past year. In fact, that has been the defining best trade of 2025. And here we have this reporter giving up the trade, presenting it to the president, saying, hey, this is what's going on. People are making a lot of money with it, and making him furious at the same time. President Trump might be so upset about the assertion that he's a chicken that he'll try to prove he's not a chicken by keeping the tariffs at the original rate, which is the worst possible outcome for investors. So we don't want a situation where he has to prove he's not a chicken by keeping the tariffs at 50 or 100%. So this is the worst possible question to ask the president. And this reporter, whoever she is the fail of the week. That's it for this episode. See you in the next one.